Greetings, class, and welcome to Friday, April 3rd. This announcement video and review video will cover some important information about assignments that are due and some things about the upcoming test. So, first things first, as far as announcements are concerned, we have one assignment due tonight, and that's this discussion for weekend in March 29th. That's last week. You need to go in here and respond to the 4 questions that I ask and at least one other student. This is worth points, okay? So this is our attendance piece. It's going to be worth points, and you want to do that. It won't take you very long to respond to those questions. Next, I want to look at these modules here because I've added a few things and I want to show you what they are. First of all, this week we finished up Chapter 11 in the module that included both Chapter 10 and 11, and so now the homework is available for Chapter 10 and 11, and that is in Connect, and it's due a week from today, April 10th at midnight, 11:59 p.m. And also to give you a heads up, over the weekend I'll be putting up another discussion. And that discussion will be for next week's attendance, and I want you to respond to those prompts in that discussion. So that's those new things. Now I want to talk about the test. So what I've included in the exam number 3 module is a practice test, multiple choice. This is for you, and then a review for that. It's in Excel. So let me explain a couple things about the way this test is going to work, because it's going to be different from our in-person tests. Number one, we're going to take this in an online capacity. And so we're going to be using the Respondus lockdown browser and monitor. And what I'm going to do by Monday is to have a practice quiz so that you'll get the chance to install Lockdown Monitor before we actually have to take the test, and you can work with it and see if you run into any issues. So far, I have been using it in another class, and I have not had a major number of issues with it. The biggest issue students have right now is making sure that they get the software set up correctly and they have all the updates on their computer so that software will install properly. Now, the other thing I want to mention about the exam is because it's going to be online, this exam will, the way it's going to work is it's going to pull from a pool of questions from chapters 8, 9, 10, and 11. And those questions are ones that we've gone over in class. There are problems we've worked multiple times. There's nothing in here that we have not covered. But because the test is the way it is, the questions will change every time. It's set up in order that when you take it, the questions will be different. So it's very, very likely that your questions will be different from another student's questions, and so on. This is in an online environment using the Respondus lockdown browser and monitor. So I'll do a separate video about the Respondus lockdown browser and monitor on Monday. I'll post that, and then we'll have our regular live session on Monday where we will go through some problem calculations that could be on the test. All right, so those things I wanted to cover. But at this moment, I want to go to this practice test. Now, what I've done is go through my questions that I have used on the test before, and pull a random sampling of those. And they're basically, there's a method to this madness. They are pulling so many from chapter 8, so many from chapter 9, so many from chapter 10, and so many from chapter 11. I believe I pulled 5 questions from each chapter, so it's pretty well distributed here. So what I'd like to do is just to walk you through this test, this example test, this practice test, and then actually what I'm going to encourage you to do is to give this a try before you look at this video, just to see how well you do with this. And if you need to, you can come back to this video to look at the answers and see exactly what you should be doing. Now, the worksheet looks like this. I've set this up similar to our other problem review worksheets, but some of these questions that are on this practice test are what you would call conceptual. They don't require a calculation. That will be the way the real test will be. You'll have at least I believe there's at least 3 or 4 questions that will be conceptual on that test when you actually get that. But at any rate, let's go through these and look at number 1 in the test here. We have which of the following statements is not correct about the cash budget? Which is not correct concerning the cash budget? Well, basically it goes through a lot of things here and says the cash budget should be prepared before the budgeted balance sheet, should be prepared before the budgeted income statement, builds on earlier budgets and schedules as well as an additional data. All those 3 statements are correct. They are correct. These are correct. The only one that is not true, and that's what you need to pay attention to, not true, is that it is not necessary to prepare any other budget before preparing the cash budget. So the answer to number 1 is going to be letter A. For number 2, we're going to do a calculation, and this is a problem where Haylock is basing its manufacturing overhead budget on budgeted direct labor hours. The direct labor budget indicates that 5,600 direct labor hours will be required in August. The variable overhead rate is $5.40 per hour or per labor hour, and the company's budgeted fixed manufacturing overhead is $69,440 a month, including depreciation of $15,680. All other fixed manufacturing overhead costs represent current cash flows. The August cash disbursements for manufacturing overhead on the manufacturing overhead budget should be. So that is the question. And here what we're going to do is we're going to calculate this cash budget similar to what we would have done in Chapter 8. So I'm going to go over to the worksheet, and we're going to pull the data out of the problem. The first thing is the budgeted direct labor hours that they give us at 5,600. And then we have a variable overhead rate of $5.40 per direct labor hour. And when we multiply those together, we're going to get the variable overhead, manufacturing overhead of $30,240. We also need to add in the fixed overhead of $69,440. And then we have a total manufacturing overhead of $99,680. Now we're going to subtract out depreciation, and depreciation here is going to be $15,680. So that when we take this minus this, we get $84,000 even, and that's going to be answer A again. Okay, don't look for patterns in the answers to these either, because this is going to be randomized, so you'll never know how you'll see these answers show up. Okay, number 3 is talking about a selling and administrative budget, and now we're basing it on budgeted unit sales. 1,300 units are planned to be sold in March. The variable selling and admin expense is $420 a unit. The fixed selling and admin is $19,240 per month, and that includes depreciation of $33.80. So if we go over here to this worksheet, we'll go to number 3, where we'll start with the budgeted unit sales. In this case, 1,300 units. And then we're going to calculate, or we're going to use a variable rate to calculate the variable selling and admin expense. So we have $4.20, and we take that calculation, and then we add in the fixed selling and admin, and that's going to be $19,240, not 340, 240. And so we add those two together, we get 24,700, but we have to take out the depreciation here, which is going to be 3380. And that gives us, when we take 24/7 minus 3380, that gives us the cash disbursements needed for selling and admin of 21,320. So if we go back here, we see that's letter B. For number 4, this is an oil well service company that measures output by the number of wells serviced. The company has provided the following fixed and variable cost estimates that it uses for budgeting purposes. And they have revenue, and they have a rate, and they have employee salaries and wages, a fixed element and a rate variable element, servicing, and other expenses. And what they're asking us is, when the company prepared its planning budget at the beginning of May, it assumed that 29 wells would have been serviced. However, 31 wells were actually serviced during the month of May. So they want us to calculate the expenses for all these categories based on the 31 wells that they serviced. So when we go over here to calculate this, we're going to start with the number of wells that they service, 31. And then we're going to calculate the employee salaries and wages. So we got 41,300 plus 1,000 times 31. So when we apply this formula to the calculation, we're going to take 31 times 1,000. So this will be 41,300 plus 31,000 times, or 31 times 1,000. Oh, I shouldn't do that. So I need to put equal sign in here, 41,300 plus, and then parentheses, 31 times 1,000. And when we calculate that, we get 72,300. For servicing materials, we're going to multiply $600 per well service. So we take 31 times 600, and we get 18,600. And finally, the other expenses is the amount is all fixed, 40,200. So we add that in. So now we have all of the components of the cost. We just need to add these up. And we'll have a total cost of $131,100. When we look at this question, it's going to be letter B. That's what we'll choose. Okay, for number 5, we have Herlocker Corporation as a shipping container refurbisher. And for them, they measure the output by the number of containers they refurbished. The company has provided the following fixed and variable cost estimates it used for budgeting. Now it says, when the company prepared its planning budget at the beginning of February, it assumed 26 containers would have been refurbished. The amount for revenue shown in the planning budget would be what? So we're going to go back and calculate this. So basically, the containers refurbished in the planning budget was 26. That's what they planned to do. the revenue per container was $4,600. So basically, the calculation here is 4,600 times 26, and that gives you 119,600. Okay. Now, for number 6, we're going to look. Oh, by the way, that question, if we look back at it, 119,600 is letter A, so that is the correct answer there. For number 6, Picozzi Snow Removal's cost formula for its vehicle operating cost is $2,060 a month plus $306 per snow day. For the month of January, the company planned for activity of 16 snow days, but the actual level of activity was 18 snow days. So the actual vehicle operating cost for the month was $7,720. What was the vehicle operating cost in the planning budget for January? So we know what the actual was, we know what the actual activity was, but they want us to go back and recreate the planning budget. So we go back and we talk about, okay, the cost is going to be equal to fixed cost. And in the planning budget, we said $2,060 in fixed cost. Plus, we're going to multiply 300 and let's go back here. $306 per snow day. So we have 306 and we have 16 snow days. That was what was in the budget, okay? So now what we need to do is just bring all this together. So we're going to calculate this by just multiplying 306 times 16. Well, I'll just do the whole calculation here. We'll have the 2,060 plus, in parentheses, the 306 times the 16, and close the parentheses, and we have $6,956, which was the original amount. If we go back to the problem, we see that's letter B, okay? Now, number 7, Runyon Incorporated reported the following results from last year's operations. They have sales, variable expenses, contribution margin, fixed expenses, and net income, and an average operating asset value of $7 million. The question asks, last year's turnover was closest to what? Well, we go back to the worksheet, and we know that turnover is going to be the sales divided by average operating assets. So from this problem, we have sales, and I'm going to do this. We have sales of $16,800,000. Okay, and we have average operating assets of $7 million. So when we divide these out, we're just going to take this divided by 7 million. We get a turnover of 2.4. So we have a turnover of 2.4 for number 6. And if we go back to that problem, the answer is letter C. Okay. Number 8 is Cerrone Inc. reported the following results from last year's operations, and they have $9 million, $6 million in sales, variable expenses, contribution margin, fixed expenses of $1,926,000, and a net operating income of $864,000. Average operating assets are $4 million, and at the beginning of the year, they're presented with an opportunity where they invest $1,200,000 with the following characteristics. They have sales of $4.2 million. The contribution margin is 30% of sales, and fixed expenses are going to be $966,000. If the company pursues the investment opportunity and otherwise performs the same as it did last year, the combined margin for the entire company will be closest to So what we want to do is we want to calculate, okay, what the contribution margin is for the company. Well, if we go back here, we see the sales and the contribution margin ratio. That will give, when we multiply those, we get the contribution margin. So we're going to take the 4,000,002 times 0.30 or 30% to arrive at the contribution margin. Okay, then we have fixed expenses. This is the I put it in the wrong place. This is the project. So 4,000,002 times 30%. Put it in the wrong column. Okay, so we get the contribution margin, and then we take the fixed expenses that they gave us of 966,000, and we subtract that from the contribution margin, and get net operating income of 294,000. Okay, so then over here we take the company. We have the contribution margin that they gave us. If we go back here and look at this, we have 2,790,000. So we just put that in 2,790,000. We have fixed expenses of 1,926,000 right there, 1,926,000. And then we have a net operating income of 864,000. So we have the numbers we need to get the total. So we're going to add these together. And add this. So we have net operating income of 1,158,000. So what we're actually going to calculate to get the margin is net operating income divided by sales. So we're really interested in looking at, I'll fix this. We're really looking at how this net operating income relates to sales. So we're going to put that number in, 1,158,000, and we're going to divide it by sales total, which if we look at the sales that we had for the company, we had 9,006,000. And if we look at the sales for the project, we had 4,002,000. So when we add those together, we get 13,800,000, and the margin is going to be this divided by the sales. Now we get 0.083913, and I would round this off. Or look at this rounding that you need to do, because when you go back to the problem, you see they give it to you in percentages, and so what this number really is in percentage would be 8.4% rounded. That's what you have for letter D. So that's the answer to that question. Number 9, Pankey has a $700,000 investment opportunity that will involve sales of $1,050,000, contribution margin of 40%, and fixed expenses of $325,500. The company's minimum required rate of return is 18%. What is the residual income? And they give you these choices. So let's go calculate that. All right, now for number 9, we want to begin with the contribution margin that they gave us, okay? So we had sales of 1,050,000 times the contribution margin ratio of 0.4 or 40%. So we have a contribution margin on sales of $1,050,000 of $420,000. Okay, so the next thing we do is we put in the fixed expenses, which is $325,500, and then we subtract out the fixed expenses from the contribution margin. We get a net income of $94,500. Average operating assets for Pankey is $700,000 for the project. Because when you're looking at this required rate of return, you want to know how much do we have invested in it, what's involved. So we take the average operating assets, we have a net operating income of $94,500, and we're going to compare that to the minimum required rate of return, which is this times 18%. So we're going to have a negative number. We go down here to calculate the residual income, take the 94,000 minus 126, we get a residual income that's actually a loss of 31,500. Going over here, you see that right here, okay? That's number 9. Number 10 says if net operating income is 70,000, average operating assets are 250,000, and the minimum required rate of return is 16%. What is the residual income? So for number 10, we could go back and do this. So we have average operating assets. That's the investment that we have in the company. We have 250,000 in average operating assets. We have a net operating income of 70,000. And we have a minimum required rate of return that multiplies those assets times 16%. So we have, something's wrong with that. I put in too many. Oh, I didn't put a decimal in. So we get a minimum required rate of return of 40,000. So we take the 70,000 minus the 40,000 and arrive at a residual income of $30,000. Okay. All right, that's number 10. And so we go back to that and we show you here it is going to be letter B. For number 11, it says Parwin Corporation plans to sell 23,000 units during August. If the company has 8,000 units on hand at the start of the month and plans to have 9,000 units on hand at the end of the month, how many units must be produced during the month? This is a budget question, a production budget question, so we need to go back to Chapter 8 to figure this out. So we start with a budgeted unit sales. The budgeted unit sales here, 23,000 units. And we add the desired ending inventory. So we want an ending inventory of 9,000 units. We add that to what we had. We get 32,000 total needs. Then we want to subtract out the 8,000 we started with. So we take the 32,000 minus the 8,000 and we arrive at 24,000. That is the amount we need to make for the month. And so when we go back here, that will be letter D. Okay. The next problem, number 12, this is a conceptual problem, and it just asks you the question, an unfavorable materials quantity variance indicates what? Well, it's letter A. It just indicates that the actual usage of material exceeds the standard material allowed. It has nothing to do with price. Okay, these two you can rule out right away. The only other option is here, but if you're below the standard, that's not going to be an unfavorable variance. It's going to be a favorable variance. So the unfavorable variance means that you're exceeding the standard. So if you're in the worksheet here, I left you a place to put an answer here. It's going to be letter A, if you want to do that. But remember, there will be conceptual questions on the test. The actual test itself is designed to give you, I believe, 3 or 4 of these. So those are going to be questions where there are no calculations. All right, so for number 13, let's take a look at that one. Tracy Corporation manufactures and sells women's skirts. Each skirt is a unit. It requires 2.2 yards of cloth. Select data from the master budget for the next quarter are shown below. And they have budgeted sales for each month, budgeted production for each month. And then it says each unit requires 0.8 of an hour of direct labor, and the average hourly cost of Tracy's direct labor is $18 an hour. What is the cost of Tracy Corporation's direct labor in September? So we're looking here, all right, in September. So we want to start by considering what are the required production units. We have 13,000 units. Okay, this is a basic direct labor budget question. How many direct labor hours do we need per unit? Well, 0.8, 0.8 of an hour. So then we calculate the number of hours. 0.8 times 13,000, we get 10,040 hours. And then we're going to multiply that times the rate that they're paying for the labor. We're going to have $18 an hour times 10,040. We get 187,200. When we look back here, we'll see that letter B is the right answer for that. So the direct labor budget question comes out to 187,200, or letter B. Number 14 is we're getting into the variance analysis out of Chapter 10 here, and it talks about Pleiss Corporation applies manufacturing overhead to products on the basis of standard machine hours. The company's standard variable manufacturing overhead rate is $2.40 per machine hour. The actual variable manufacturing overhead cost for the month was $5,240. The original budget for the month was based on 2,100 machine hours. The company actually worked 2,270 machine hours during the month. The standard hours allowed for the actual output of the month totaled 2,280 machine hours. What was the variable overhead efficiency variance for the month? Well, when we look at this, we want to remember these formulas that we have. The variable overhead efficiency variance is the actual hours minus the standard hours times the standard rate. So in this problem, number 14, we have actual hours of 2,270. We have standard hours of 2,280. And we have a rate of $2.40 per hour, 2.40. So what we're going to do is we're going to take, I'm going to take the 2.4 times, and then in parentheses I'm going to put 2270 minus 2280, which is the formula that we want to use. I just reversed the order, but we get a negative amount. We get negative $24, and when we get a negative amount, that means that this is below the standard, which means it's also a favorable variance. So we have a $24 favorable variance there. Okay, number 15, Viger Corporation has a standard cost system in which it applies manufacturing overhead to products on the basis of standard machine hours. The company has provided the following data for the most recent month, and we have the machine hours for budget, the machine hours for actual, the standard variable manufacturing overhead rate, and then the actual total variable overhead. What was the variable overhead rate variance for the month? So we're going to go back with number 15. We're going to calculate that. So again, we're going to calculate the variable overhead rate variance as actual hours times actual rate. So when we look at this, the actual hours times the actual rate, well, the actual overhead, they give it to us. We don't have to go back and recalculate it because they give us the actual total manufacturing overhead. And that would be what we would put in here where we say actual hours times actual rate. So right here, we're going to put in the total dollars of $60,930, which they gave us in the problem. So if we look at the problem back here, we're using the 60,390, not 930. Accountants' tendencies are to transpose numbers. Well, at least for me. And then we're going to subtract that, the actual hours times the standard rate. It's not minus, it's times. I don't know why I put the minus sign in here. But anyway, I'll just do this right here. So we have the actual hours, which are 9,900. And we have the standard rate, which is 630. So what we want to calculate is 60,930, 390, I did it again, 390 minus, in parentheses, 9,900 times $6.30. Close the parentheses. I need to put the formula indicator in. And we get a favorable rate, because it's negative, of 1,980. It's less than the standard. So 1,980 less than the standard. So if you go back here to the question for number 15, you're going to have this 1980 favorable variance, letter D. If the number is less than the standard, it's always favorable. Chavin Company had the following results during August: net operating income of $220,000, turnover of 5, return on investment of 25%. Chavin Company's average operating assets were what? So again, this is one of those formulas where they give us something else other than what we were used to seeing when we were doing actually calculating. Let's go back here. When we're actually calculating the ROI, what we were doing is we were taking the net operating income divided by average assets, okay? So that's a standard formula. Income divided by average operating assets is going to equal return on investment. If we go back here, what we need to do is rearrange that. Instead of saying net operating income divided by average operating assets, we need to switch the return on investment and average operating assets, because we have the return on investment number, but not average operating assets. So we put the 220 here, 220,000, which is the net operating income, and we're going to divide that by 25% here. Well, I'm going to put it in as 0.25, but it is 25%. So then when we actually do the calculation, we take the 220 divided by 0.25, we get 880,000. And if you want to test the number, just take the 220 divided by 880 and you'll get 0.25 or 25%. And that's the return on investment. Okay, that's number 16. Now we'll move on to number 17, and this is another variance question. And basically, number 17, if we go back to the problem, ask you a question. It says, Kryzen Industries makes heavy construction equipment. The standard for a particular crane calls for 20 direct labor hours at $24 per hour. During a recent period, 875 cranes were made. The labor efficiency variance was $1,200 unfavorable. How many actual direct labor hours were worked? And again, this is one where we know the formula, but they're not giving us the information that we normally have. So we're solving for the missing piece. So we're going to set this up like we have here. Variance is going to equal the calculation of the hours difference times the standard rate. So we have $1,200 unfavorable variance equal actual hours minus 875 cranes times 20 hours per crane. Because we're looking back here and we're saying the standard calls for 20 direct labor hours per crane. And then we go back here and we say actual hours minus 875 times 20. All of that times $24 per hour. So we say, okay, we have this actual, this variance, this unfavorable variance. We have the actual is going to equal 875 times 20. And that's 17,500 times the $24 per hour. Now we need to rework this equation a little bit so we can actually get this to solve somewhere where we can solve it. So we're going to say, so what we say is $24 per hour times the 17.5 and $24 an hour times the actual hours. So if we were to rewrite this, we could say 1,200 equals, I did the wrong thing again, I'll just copy it. Parentheses, actual hours times 24. And then we have minus, and that will be minus 17.5. I'm going to put this in as a formula, 17.5 times 24. So we have 420,000. Now we can rewrite this whole thing so that we actually get it so we can solve it. So what we do is we say, okay, the actual hours times 24 here. On the other side of the equal sign, we're going to have 420,000 plus 1,200. So I'm going to put this in as a formula, but we have 420,000 plus 1,200. So on this side we have 421.2. And over here we have the actual hours, and we're going to divide both sides by 24. So we have actual hours here, and this is going to be 421,000 divided by 24. So what we get then is actual hours equals 421,200 divided by 24. and we get 17,550. So that's the number of actual hours that we had. And if we look at this, it makes sense because the standard is 17.5. This is 17.550, and this is an unfavorable variance. So if we go back here, we come up with letter C. Okay. Now we go to number 18, and this is another conceptual question that you're going to see. And it asks you which of the following segment performance measures will decrease if there's an increase in the interest expense for that segment. Return on investment, no, it will not decrease. And residual income, no, it will not decrease. So the choice here is letter D. For both of these, interest expense does not impact their calculation, because we're using, when we calculate return on investment, we're using earnings before interest and taxes. If you recall, in the Chapter 11 PowerPoint, they mentioned that. We use that for both of these, earnings before interest and taxes. Okay, so going on, number 19. TOS Company's flexible budget cost formula for indirect materials, a variable cost, is 60 cents per unit of output. If the company's performance report for the last month shows an $800 unfavorable spending variance for indirect materials, and if 9,000 of the units of output were produced last month, then the actual costs incurred for indirect materials for the month must have been. Well, we want to set this up because they're really talking about Chapter 9, flexible budget versus what we had planned. So let's take a look here. So let's go to this number 18. Oh, number 18 was just a letter D. So let's skip that and go to 19 here. So we're going to set it up like a we're going to look at the actual results compared to the flexible budget. So the units of output in actual were 9,000. The units of output in flexible budget was 9,000 units. When we're comparing those two, though, we wind up with an $800 favorable variance. So what is that going to be? Well, it's going to be the variance. We're going to have a variance of $800 is going to be equal to the actual dollars. What were the actual dollars? We don't really know because they don't give it to us. But that subtracting the flexible budget, we know the flexible budget was 9,000 times 60 cents. That's going to be 5,400. So we had the actual, the flexible budget was based on 9,000 times the quantity, which is 60 cents per quantity. So we have 5,400. Okay. So now we have, what is this difference? Well, if we take 5,400 and bring it over to this side, we're going to add that in, and actually the actual will be 6,200. Or you could just work it backwards if you want. You could say, okay, 5,400 subtracted from what is going to give me 800, 6,200. Very straightforward. So this calculation then, 6,200, letter C. And number 20, a total of 6,850 kilograms of a raw material was purchased at a total cost of $21,920. The materials price variance was 1,370 favorable. The standard price per kilogram for the raw material must be what? So we're going to go down to number 20, and we're going to look at the materials price variance. We have a materials price variance of 1,000. We're going to use that formula. We have 1,370, and that's a favorable variance. Remember that. It's favorable. So we have the variance, and that variance is equal to it's equal to the actual cost that we have, and they give that to us. We have cost of $21,920. So we can come back here and we can say, okay, well, this one needs to be $21,920 because that's the actual cost that we spent for it. And then we would have that subtracting out the actual quantity times the standard price. Well, the actual quantity is 6,850 kilograms times the standard price. So we're going to rework this thing a little bit. This favorable variance would be a negative number. So we're going to have a negative, well, not that. We're going to have a negative 1370 instead of saying favorable, we're turning a negative number, and we have the rest of the formula the same. So I'll just put this in as negative. Okay, when we work this formula and rearrange it, we're going to have, we're just going to flip sides a little bit. We're going to have the 6850 kilograms times standard price, and we're going to have that equal to 21,920 plus 21,920 plus the 1370. Because it was a negative on that side of the equation, it becomes a positive on this side. So we're flipping it around. So we're adding 1370 to both sides, and this is what we come up with. All right, so now we can solve the standard price, because what we're going to do is we're going to say the standard price is equal to 2320 or 290 divided by 6850. So we have this, and that means that this standard price is going to be equal to this divided by 6850, $3.40 per kilogram. So we go back to the problem and we identify letter C. Okay, now this is just the multiple choice section of the test, and like I said before, I want to emphasize this. This is just a sampling. I can't guarantee you that these are the problems that are going to look this way on the test, but I can guarantee you that some of these problems or problems like them will be on the test. I can't tell you exactly what the mix will be because of the nature of giving the test online and the way that the test has been created. The test will change from each user to each user. I can tell you with certainty that there will be an equal number of questions from all 4 chapters, and that you will have some conceptual questions on the test. It won't be a ton of conceptual questions, but you will have some. And the conceptual questions are those that you don't really have to do a calculation for. However, I will post and have posted this worksheet so you can use it online to go along with the video. And I've posted this document as well. So what I'm going to say here is in this test, in this practice test, you're just going to have a sampling of what could be, but again, you need to be prepared for everything that we did in class. So what we've done here is just go over some of that, refresh your memory. On Monday, we'll go through some problems together that are the longer problems. There will be 20 multiple choice, and there will be approximately 3 to 4 problems. We'll see how long they are. And then that'll be the test. Also on Monday, I'll post a practice test so you can get used to using the Lockdown browser and monitor. All right, everybody, take care. We'll see you on Monday.